Have you ever stopped to think about, well, a really basic idea in finance? This assumption that every single financial decision is, totally rational.
Mm-hmm. It's sort of the bedrock of traditional economics, isn't it? Like the efficient market hypothesis, it all kind of hinges on that rationality.
Yeah, but then you look around at the real world and say, well, it doesn't always seem to fit, does it?
Exactly. I mean, if everyone was perfectly rational, why do we get these huge stock market booms? And then the inevitable busts.
Right. Rationality should mean things are steadier, more predictable maybe, not these wild swings.
What about things like mergers and acquisitions? You hear about these deals that just seem off, maybe really poor value, even after they've done all the so-called due diligence.
It really makes you wonder, if a company's shares are traded publicly, shouldn't its value, be pretty clear for an acquisition?
I would think so.
So why all the uncertainty? Why do so many deals run into trouble later on? Feels like there's something else, something deeper going on than just the balance sheet.
And that something deeper, that's exactly what we're diving into today. We're talking about behavioral finance.
Okay.
It's this really fascinating area where psychology meets economics. It looks at how actual human behavior, our biases, our emotions affect the decisions investors and financial managers make in the real world.
So it helps explain why things don't always look purely rational.
Precisely, and why that can lead to some surprising, maybe even unpredictable outcomes in the market. So our mission today is to really unpack these psychological influences for you.
All right, let's do it.
Yeah.
Because traditional finance, it does lean on some assumptions that, on the surface, sound pretty reasonable.
Yeah, three main ones usually.
The first one is that people, whether investors or managers, are always trying to maximize their utility.
Yeah.
Their satisfaction, basically. And they do that by maximizing portfolio value or company value. It's all about the gain.
Pure profit motive, yeah. And the second assumption, that they base all their decisions on a really careful, unbiased look at only the relevant information.
Cutting through the noise, focusing just on the facts that matter.
And the third assumption is that the analysis itself is always rational, totally objective, and risk neutral.
It paints this picture of a decision maker who's almost like a perfectly logical machine, right?
Yeah.
Just crunching data.
But behavioral finance comes along and says, hold on a minute. It really challenges every single one of those.
How so?
Well, it suggests that while those assumptions look neat in a model, real human behavior often strays pretty far from them. Let's take that first one. Do financial decisions really always maximize utility and value? Or does our human nature get in the way?
Okay, let's look at investors first. You'd automatically think it's all about the money, right? Making the biggest profit.
That's the standard view.
But when you actually look closely, you see investors considering things that aren't purely financial. Like maybe they really want to invest in companies they see as socially responsible.
Or the flip side, actively avoiding certain sectors, sin stocks, they sometimes call them, because they just don't align with their personal ethics.
So it's not just the bottom line. Values come into play.
Absolutely. And psychology runs deep here. Think about the pain of admitting you were wrong about an investment.
Oh yeah, that stings.
Right. So investors might hold on to shares that have tanked, even if rationally recovery looks, well, pretty unlikely.
Why would they do that? Just hoping.
It's often to avoid that psychological hit of admitting the initial decision was bad. It's a classic case of cognitive dissonance. We want our beliefs and actions to line up, and admitting a mistake creates this uncomfortable tension.
So that need for consistency can actually cost you money.
It really can. Holding on when you should sell. Now, it's not just individual investors either. What about finance managers?
Okay, so traditional finance says they're purely focused on maximizing shareholder wealth. That's their job.
That's the textbook definition. But then you have things like agency theory, which points out that managers might have their own goals.
Like what?
Well, maybe boosting their own reputation, making themselves look good, or maybe securing their job, or even just chasing short-term bonuses that benefit them personally, even if it's not the best long-term move for shareholders.
So, a potential conflict of interest there.
Exactly. And think about contested takeovers when multiple companies are bidding for the same target.
Things can get heated.
They really can. Studies show the acquisition prices often get bid up way beyond what seems reasonable based on the target's value.
Why does that happen? Ego.
That could be part of it. One theory is that once managers get into that fight, just winning the target, acquiring the company others wanted, becomes a huge source of satisfaction in itself.
Ah, so it's not just about the asset, it's about the win.
Yeah, and they become really unwilling to lose that target to a competitor, even if the price gets totally out of whack. That's a powerful example of loss aversion bias. We feel the pain of a loss much more strongly than the pleasure of an equivalent gain. Losing the deal feels worse than overpaying feels bad, if that makes sense.
Wow, okay. So the why behind decisions isn't always pure profit. What about the what? The information we use. Do we really stick to only relevant stuff?
Another great question where behavioral finance offers some insights, because especially for investors, this is where things get really interesting. Our brains often take shortcuts.
How so?
Well, sometimes we simplify decisions by grabbing onto information that's easy to find, even if it's not actually relevant. This is called anchoring.
Anchoring. Give me an example.
Okay, say an investor is looking at a stock. They might see its price used to be much higher in the past.
Right.
And they might anchor on that past high price thinking, oh, that's its real potential, even if a solid, rational analysis of the company today suggests the price is likely to stay low. They're stuck on an old number that doesn't really mean anything now.
Gotcha. Using an irrelevant benchmark.
Exactly. Or what about the due for a change idea? You know, the gambler's fallacy.
Look at the roulette wheel. Believing red has to come up after a run of blacks.
Precisely that. Investors sometimes do the same with stocks. A stock price has been going up for a while and they think, okay, it's been up long enough, it must be due for a fall soon. So they sell.
Even if the fundamentals still look good.
Even if rational analysis suggests the upward trend could continue, they're applying faulty probability logic thinking. Past events influence future independent ones.
Okay, that makes sense. What else?
Then there's the power of the crowd, the herd instinct.
Buying or selling just because everyone else seems to be doing it.
Yeah, it can come from a basic human need to conform, to fit in, or maybe it's just a lack of confidence. Well, if everyone is buying, they must know something I don't.
And that can move markets.
Hugely. This collective behavior can drive prices way up, sometimes creating bubbles like the dot-com bubble back in the day. It wasn't always fundamentals driving those valuations. It was a shared belief, a herd mentality.
So it's not just amateur investors doing this stuff?
Oh no, there's a lot of what's called noise in the market. And noise traders can definitely include professionals. These are people who aren't basing trades on deep fundamental analysis of a company's value.
What are they basing them on then?
Maybe poorly timed decisions, gut feelings, or following trends like chartism, trying to predict future prices just by looking at patterns in past price movements.
Like reading tea leaves almost.
Kinda, yeah. It ignores the actual business reality. It's a tempting shortcut, but it's not grounded in fundamentals.
Yeah, even professional fund managers?
They're human too. Some might say shift their portfolios around between sectors periodically, not necessarily because the old sectors are bad, but just to look like they're actively managing things. Optics.
Appearing busy.
Could be. Or another bias.
Right.
Some large funds might systematically ignore companies with small market capitalizations just because they're too small to make a difference to the fund's overall performance, or internal rules prevent it.
And that leads to?
It can lead to a small capitalization discount, where these smaller companies' shares are undervalued simply because the big players aren't buying them, not because the companies aren't good.
Fascinating. Okay, let's switch back to finance managers. How does their use of information get skewed? You mentioned acquisitions earlier.
Right. Sometimes the decision to bid for another company seems less about a cool-headed assessment of the target's actual potential and more about the acquiring manager's belief in themselves.
Overconfidence.
Very much so. They might genuinely believe their management skills are so good they can turn around any target, no matter how shaky it looks on paper. They overlook the real challenges.
And you mentioned something about PE ratios.
Yeah, this is a classic sign of that overconfidence. Why would a manager argue that a target company, maybe one with poor performance, should be valued using the acquirer's much higher price-earnings ratio?
Because they think they can magically make the target perform like their own company.
Essentially, yes. They believe their own company's valuation metric is the right one for anything they touch. And once a strategy, like an acquisition, is in motion, well, it's hard to back out.
Especially if it starts to look like a mistake.
Exactly. Managers might fall into entrapment. They worry about losing face, about the damage to their reputation if this big strategic move fails.
So instead of cutting their losses,
they might actually commit more money, more resources, trying desperately to make it succeed. pouring good money after bad rather than admitting defeat and minimizing the damage. It's tough to walk away from something you're heavily invested in personally and professionally.
Okay, so our goals can be mixed, the information we use can be flawed. What about the actual analysis? Is that truly rational, objective, and risk neutral, like the traditional model assumes?
Well, this is where biases really come home to roost. For investors, a huge one is confirmation bias.
Seeing what you want to see.
Pretty much. We tend to actively seek out and pay attention to information that confirms what we already believe about an investment, and we conveniently ignore or downplay anything that contradicts it.
Can you give an example?
Think back to the dot-com boom again. Some investors were laser-focused on the potential of new technology, valuing these companies at enormous premiums.
Right.
But they might have completely ignored traditional valuation models like discounted cash flow analysis that clearly showed these companies were wildly overvalued based on actual earnings or prospects. Their brains filtered the information to fit their optimistic belief.
Okay, confirmation bias. What else affects analysis?
Attitudes towards risk are a big one. Traditional theory kind of assumes a rational, risk-neutral investor looking at long-term expected values. But in reality,
People are different.
very different. Some investors are really drawn to long shots. They love the idea of hitting that one investment that provides massive returns, even if the statistical probability is tiny. The thrill of the possibility outweighs the odds.
The lottery ticket mentality almost.
Yeah, sort of. And then you have the opposite. Investors driven by regret aversion.
Fear of messing up.
Yeah, the fear of making it a decision that leads to a loss and then feeling that awful regret. So they might actively avoid any investment that has a risk of loss, even if, on average, the expected long-term gains look really good.
They prefer safety over potential upside.
They'd rather have steady, predictable, even if low profits than face the possibility of losses, even if gains are more likely overall. That feeling of potential regret is just too powerful.
Makes sense.
What else?
There's also recency bias. We tend to give much more weight to information that's recent.
The latest news, the last earnings report.
Exactly. We focus on the most immediate data points. This can cause investors to overreact when new information comes out. A good earnings report, the price shoots up fast. Bad news, it plummets.
And then?
Often over time, the price drifts back towards a more balanced equilibrium as the initial overreaction fades. We put too much emphasis on the latest thing.
Can you mention a feel-good factor? Yeah, sometimes called the momentum effect. When share prices have been rising for a while, it can create this general feeling of optimism in the market.
People get more confident.
Exactly. That optimism can make people more willing to invest, which can push prices even higher, potentially making booms last longer than fundamentals justify. Or, conversely, deepening busts when sentiment turns negative. It's like a self-feeding loop of emotion.
And finance managers, are they doing this too?
Absolutely. They're not immune. They definitely show confirmation bias, looking for data that supports a deal they already want to do, and maybe ignoring red flags.
And relying on shortcuts.
Yes, using flawed, overly simple benchmarks, like maybe just accepting the valuation provided by the target company's directors as a good enough indicator of fair value.
Even though the sellers are obviously biased towards a higher price.
Right. Instead of doing the hard work of a truly independent, rigorous analysis, they take the easy but potentially biased number.
Wow. It really sounds like human psychology just constantly messes with the idea of perfectly rational finance.
It certainly provides a different perspective.
But surely this whole field of behavioral finance isn't accepted by everyone. What do the traditional finance folks say? What's the counter-argument?
That's a fair point. There is definitely pushback. A key argument revolves around market discipline.
What does that mean?
The idea is, okay, maybe individuals make irrational choices sometimes, but when they participate in a market, the market itself kind of disciplines them.
How?
Well, people learn from experience. If you consistently make bad, irrational decisions, you tend to lose money. And eventually, the argument goes, those people are pushed out of the market, leaving the more rational players.
So the market weeds out irrationality over time.
That's the theory. And related to that, critics often argue that these behavioral effects, these biases, they might cause short-term blips or anomalies in prices.
But not long-term shifts.
Exactly. They'd say that in the longer run, general theories like the efficient market hypothesis still broadly hold true. Markets might wiggle around due to irrationality in the short term, but they eventually gravitate back towards rational valuations as proper information gets absorbed.
So it's an ongoing debate then.
Very much so. It's about whether these psychological factors are just minor noise or if they fundamentally change how markets work.
So wrapping this up, what's the big takeaway here? Behavioral finance seems, well, really important for understanding what actually happens.
I think it offers a crucial lens, definitely. It helps explain why financial decisions often don't follow that neat, purely rational script.
Right. It gives us reasons for the real-world things we see. The market mood swings, the booms, the busts.
And the challenges in things like mergers, where the price paid can seem way off from a purely rational calculation. It highlights that gap.
It's a strong reminder, isn't it? We like to think of finance as all logic and numbers.
But it's deeply tangled up with us, with human psychology. Our biases, our emotions, our shortcuts, they're all in the mix.
Which leads to a final thought, maybe for you listening. If even the supposed experts, the finance professionals and the markets themselves, are swayed by these pretty fascinating biases, how might understanding them change your own everyday decisions? Not just financial ones, but any decision, really.
Yeah, something to think about. Maybe even watch out for in yourself.